South Korea halts trading as Asian markets plunge on Iran war fears. 1. Introduction. Good everyone. Today we're going to discuss one of the most dramatic financial events in recent global market history, the sudden and sharp plunge of Asian stock markets, with a specific focus on South Korea's stock exchange halting trading due to escalating fears of a widening war involving Iran. On March 4, 2026, global markets, particularly in Asia, experienced a substantial downturn, driven by intensified geopolitical tensions in the Middle East, surging oil prices, and investor anxieties about the global economic outlook. At the center of this event was the KOSPI, South Korea's main stock index, which plunged so sharply that market regulators had to halt trading temporarily using circuit breaker mechanisms designed to slow panic-driven sell-offs. In this presentation, we will explore what exactly happened in the markets, why South Korea was especially affected, how trading halt mechanisms work, the role of geopolitical risk and oil prices, the regional and global impact, historical analogies, and what this means for the future. By the end of this script, you'll have a well-rounded understanding of the event from financial, economic, geopolitical, and systemic perspectives. 2. Setting the stage, global geopolitical tension. To understand why South Korea's markets plunged so sharply, we need to first look at what triggered global risk aversion. 2.1. The escalating conflict. In early March 2026, an escalating military conflict in the Middle East, involving the United States, Israel, and Iran, intensified significantly. These developments included airstrikes by the U.S. and Israeli forces on Iranian targets, Iranian retaliation against neighboring countries, warnings from Iran about closing or disrupting the Strait of Hormuz, one of the world's most vital oil supply routes. The Strait of Hormuz alone handles nearly 20% of global oil shipments, and any threat to its operation sends shockwaves across energy markets. This situation triggered broader global fears of a prolonged Middle East war, and financial markets around the world reacted immediately. 3. Immediate financial market reaction. Once the conflict intensified, two major financial systems reacted rapidly. 3.1. Oil prices surge. Crude oil prices began rising sharply. Brent crude climbed to the mid-$80 range per barrel. Energy traders grew increasingly nervous about supply disruptions. Inflation expectations rose, damaging investor confidence. Oil is a key input for most modern economies, and a spike in oil prices, especially rapid ones, raises production costs, transport costs, and inflation expectations, which in turn hurt economic growth prospects. Investors often react to such shocks by selling risk assets like stocks. 4. South Korea's specific vulnerability. Why did this situation impact South Korea's market so severely? 4.1. Energy dependence. South Korea is among the world's largest importers of crude oil, most of which comes from the Middle East. When oil prices surge, South Korean companies face higher production and logistics costs, reduced profit margins, lesser consumer spending. Heightened oil prices directly impact the South Korean current account deficit, corporate earnings, and export competitiveness, especially in energy-intensive manufacturing sectors. This economic vulnerability makes South Korean markets especially sensitive to Middle East geopolitical risk. 5. The KOSPI crash, a breakdown. The KOSPI, Korea Composite Stock Price Index, South Korea's most widely tracked stock market benchmark, experienced a historic plunge. 5.1. The scale of the drop. In early trading on March 4th, KOSPI plunged more than 12%. Major technology stocks like Samsung Electronics and SK Hynix saw double-digit losses. A broad sell-off spread across all sectors. The dramatic drop reflected panic selling as investors rushed out of equities into safer assets like gold, U.S. Treasuries, and cash. 5.2. Trading halts and circuit breakers. In response to this freefall, the stock exchange activated circuit breakers, predefined rules that halt trading temporarily when prices fall beyond certain thresholds. This is done to give investors a cooling-off period, reduce the pace of panic selling, prevent disorderly markets. The circuit breaker system in South Korea triggered because the index declined by over 8% within a short period. This led to a temporary halt in trading for both the Kospi and the Korean tech-focused KOSDAQ. 6. Investor psychology and market mechanics. At a deeper level, the market plunge and trading halt reflected real investor psychology. 6.1. Risk aversion and flight to safety. When geopolitical uncertainty rises, investors often sell stocks, increase holdings of safe assets, gold, bonds, reduce exposure to riskier markets. This dynamic is compounded by algorithmic and quantitative trading, which can amplify moves through automatic sell orders. 6.2. Technical factors. Markets that were already at high valuation levels, like South Korea's markets in 2026, are particularly susceptible to quick reversals. The Kospi had seen an AI-driven rally earlier in the year. Many asset valuations were historically high. Rising interest rates and inflation expectations added to vulnerability. These technical factors made the downturn sharper once geopolitical fear took hold. 7. Broader Asian market impact. South Korea wasn't alone. Japan's Nikkei 225 fell sharply. Hong Kong's Hang Seng and Taiwan's TAIEX also declined. Other regional markets entered correction territory. This was a region-wide risk-off move triggered by the same fear of prolonged conflict and higher energy costs. Several Asian markets dropped more than 2 to 3%, and the overall MSCI Asia-Pacific Index showed substantial weakness. 8. Spillover effects on global markets. 8.1. Europe and the U.S. While this report focuses on Asia, it's critical to note that global markets were not immune. European stock indices also slumped. U.S. markets showed weakness, with key indices moving lower. Safe havens like gold and government bonds rallied. This global sell-off reflected interconnected financial economies where shock in one major region, especially in energy markets, rapidly spreads to others. 9. Short-term consequences. 9.1. Investor wealth erosion. The market plunge wiped out hundreds of billions of dollars in market capitalization across global equities. 9.2. Currency market impacts. Currencies like the South Korean won weakened against the US dollar as investors moved capital into perceived safe havens. 9.3. Risk asset repricing. Asset prices in the short term moved to reflect higher uncertainty, lower equity valuations, higher commodity prices, expensive safe asset yields. 10. Historical context. This event draws parallels to other risk-off episodes in financial history. The 2008 global financial crisis, sharp sell-offs, the COVID-19 market crash of March 2020, geopolitical shocks that have previously rippled through global markets. However, what made this instance notable was the combination of geopolitical escalation and supply-side energy risks hitting a market already priced for growth. 11. What comes next? Economic outlook. A key question is, what happens next? 11.1. End of conflict or escalation. Markets tend to stabilize when clarity returns to international relations, or when diplomatic efforts reduce the risk of broader war. 11.2. Energy market stability. Oil prices and energy supply stability will play a central role in shaping economic recovery. 11.3. Central bank policies. Central banks will be closely watching inflation indicators and equity market performance, which could influence interest rate decisions. 12. Key lessons. Here are some core takeaways. 1. Geopolitical risks matter. Even distant conflicts can impact markets globally. 2. Energy dependence can drive vulnerability. Import-dependent countries are especially exposed. 3. Trading mechanisms like circuit breakers play a crucial role. They help stabilize markets but also signal extreme stress. 4. Markets are interconnected. Events in one region can affect investor behavior worldwide. 13. Conclusion. In conclusion, the dramatic plunge of South Korea's stock markets, leading to a halt in trading, underscores how geopolitical turmoil and economic fundamentals interact to shape financial markets. The Kospi crash was not simply a market event. It was a reflection of rising geopolitical tensions, market psychology, technical trading mechanisms, energy price impacts, and global financial linkages. Understanding these elements helps us not only interpret today's events, but also prepare for future shocks in an increasingly interconnected world.